I'm an accountant and an investment banker, and I did not start investing seriously till my 30s. Now, due to visa and personal issues, I did not have a job that I have today. So basically, my investment journey started when I was 34. Now, I thought I was the only one who started this late. But then I saw a Wells Fargo survey, and it turns out that majority of Americans in their 30s and 40s are afraid of investing because of the fear of losing money, as they are hyper conservative due to their existing lifestyle, and also because of the fear of retirement, which by now is looming over the horizon. But the good news is that even if you're starting later than you hoped for, there's still time to build a strong foundation for a comfortable retirement. So in this video, let's go over why investing in your 30s and 40s is so important and how you can make the most of your investment strategy that maximizes returns while minimizing risk. But before we jump into numbers, let's take 2 minutes to discuss why investing in your 30s and 40s is so important. For starters, the 30s and 40s are your amazing years financially. You likely have a steady income, you're at the peak of your earning potential, and you're closer to meeting some of your major financial milestones like paying down student loans or saving money for a down payment on a home. On the not so amazing side, you're also getting closer to retirement. So this is a critical time to start investing if you haven't already. The benefits of investing in your 30s and 40s include harnessing the power of compound growth. You can benefit immensely from the power of compound growth. Each dollar that you invest today has the potential to grow significantly, especially if you give it 15 to 20 years. You can be assured of financial security for later years. Investing now helps ensure you'll have enough to support the lifestyle that you want in your retirement. And you can reduce the pressure to catch up later. Waiting until your 50s to start investing can lead to the pressure to take higher risks. By investing now, you can create a balanced portfolio without the pressure of needing immediate higher returns to compensate for lost time. And this is also precisely why taking too much risk isn't advisable at this age. Because you have a shorter investment horizon. With 20 to 30 years left until retirement, there's less time to recover from a market downturn. Unlike younger investors who have decades to rebound, you may need access to your funds sooner, so preserving capital becomes more critical. You also have growing financial responsibilities such as mortgage payments and healthcare costs that require a stable financial base. A large financial loss could disrupt these obligations and leave you without adequate funds when you need them. And this is also why you shouldn't indulge in risky assets to get higher returns, as they come with the potential for higher losses. A balanced approach can help you grow your money at a steady rate while reducing the stress of market volatility. Now to the meat of the subject. How can you build a strategic portfolio to maximize returns and minimize risk? Well, it all starts by creating a portfolio that balances growth with stability. The 5 core investment types that I suggest people to invest in their 30s and 40s are index funds, equities, bonds, real estate, and alternative investments. So let's start with index funds. Now, investment funds are my absolute favorite mode of investment as it is relatively risk-free and provides long-term results that exceed the market average. Now, index funds are investment vehicles that track the performance of a specific market index like the S&P 500 or the Dow Jones Industrial Average. Instead of picking individual stocks, these funds invest in a basket of stocks that represent the index. Now, this approach gives you instant diversification and exposure to the broader market by creating a portfolio that balances growth with stability. Now, there are a couple of reasons why I love index funds. It provides diversification without the risk. An S&P 500 index fund gives you ownership in 500 of the largest US companies, from tech giants like Apple and Microsoft to healthcare leaders like Johnson & Johnson. So if Apple shares fall down in price, chances are high that they will be more than compensated by growth in some healthcare stocks like Johnson & Johnson, thereby keeping your profits stable. They are relatively inexpensive. For example, the Vanguard S&P 500 ETF has an expense ratio of just 0.03%, meaning you pay $3 annually for every $10,000 invested. If you compare that to an actively managed fund charging 1 to 2% annually, you would be saving thousands in fees alone. And index funds are consistent in performance and in giving you higher returns. Over time, the stock market has historically delivered an average annual return of 8 to 10%. Index funds, like those tracking the S&P 500, mirror this performance. So for example, if you invested $10,000 in an S&P 500 index fund 20 years ago, your investment could now be worth over $60,000, assuming an average annual return of 8%. And lastly, they are easy to manage. You don't need to spend hours researching stocks or timing the market. With index funds, you simply invest regularly and let the market do its job. You can also automate contributions to an index fund through the 401k and Roth IRA account to make investing seamless. So how should you invest and how much of your portfolio should be index funds? Well, it depends upon 2 questions: your risk appetite and your funding capacity. If your funding capacity and risk appetite is low, I would suggest to invest 100% of your investment money in index funds. Now, this is a great way to build wealth on a long-term basis. For people with some money flexibility, I would suggest to invest 50 to 60% of your portfolio in index funds. But the best way to begin investing in index funds is through tax advantage accounts, which offer built-in benefits that accelerate your wealth building. The two major programs offered in the US are the 401k and the Roth IRA account. Now, these are tax advantage accounts that are designed to help you grow your money efficiently, but they work in different ways. The 401k is generally offered by your employer with matching contributions up to a particular amount or percentage. If you are employed and your company offers a 401k with an employer contribution match, you should be contributing because it is essentially free money. On the other hand, a Roth IRA is one of the smartest tax saving strategies available, allowing your money to grow tax-free over time. So that was the summary of the index funds. But how do you actually invest in them? Well, start with the 401k. A 401k is an employer-sponsored retirement savings plan that allows you to contribute a portion of your pre-tax salary to an investment account. The money is then invested in various assets like index funds, mutual funds, or target date funds. The way this works is that you decide how much of your salary you want to contribute. The annual limits are set by IRS, which as of 2025 is $23,500. Since contributions are made with pre-tax dollars, your taxable income is reduced. What this means is that when your salary is due, your employer will deduct a portion of your salary and deposit it into the 401k account. Less taxable salary means less taxes. Now, here's the important part. Many employers offer a match, such as a dollar for dollar up to 3 to 5% of your salary. This is free money that instantly boosts your savings. So at a minimum, make sure to invest at least to match your employer's contribution so you can maximize this benefit. Your investments grow tax deferred, meaning you don't pay taxes on your gains until you withdraw the money at the time of retirement. After age 59 and a half, you can withdraw this money, but withdrawals are taxed as ordinary income. Since a major chance is that your tax bracket during retirement would be less than what you have now, it makes a lot of sense to invest when you earn more, which is in your prime years, to withdraw when you earn less, which is after retirement, to save a ton in taxes. Now you probably get a view of why everyone should be contributing to a 401k. The compounding and tax saving strategies of this investment make it one of the most lucrative investment types out there. Now let's talk a bit more about his brother, the Roth IRA account. A Roth IRA or individual retirement account is a personal retirement savings account that allows for tax-free growth and withdrawals in retirement. The difference between the 401k and the Roth IRA is that contributions to 401k is pre-tax, but Roth is post-tax. Now the way this works is that you make after-tax contributions, which essentially means that you pay tax on your salary and only after that you make contributions to the Roth. The money then gets invested in various assets similar to 401k like index funds, mutual funds, or target date funds. Now, since you have already paid tax on your contribution, the growth within the fund happens tax-free, which basically means tax-free withdrawals. After age 59 and a half, all withdrawals, including gains, are 100% tax-free as long as you have held that account for at least 5 years. Also, no required minimum distributions or RMDs. Unlike a 401k, a Roth IRA doesn't require you to withdraw money at a certain age. This provides greater flexibility in retirement planning. The Roth is a cheat code that everyone should invest by the mere fact that its gains are tax-free. However, there are income limits to contributing into the Roth. If you're single, less than 50 years old, and make less than $150,000, your contribution limit per year is $7,000. If you're more than 50, then it's $8,000. If you're married and file joint tax returns, the age conditions remain the same, but your salary eligibility increases to the max of $236,000 as of 2025 to contribute $7,000. Now, as a banker, I always recommend people to maximize long-term returns by combining contributions to 401k and the Roth IRA accounts. Now, contribute enough to the 401k to get the full employer match. This is essentially free money and should be a priority. And then max out your Roth IRA. Take advantage of tax-free growth and withdrawals. If you still have money left to invest, increase your 401k contributions to the maximum allowed. So moving on to the second investment type, which is equities. Now in equities, I generally recommend to invest around 20%. Now, equities, also known as common stocks or shares, are a powerful tool for growth as they tend to provide good returns over time. Now when you buy a share, you own a small piece of that company. If the company grows and becomes more valuable, so does your investment. Now many people believe that equities are difficult to invest as the stock price can go anywhere. But with the right strategy, you can make money. So some basic things to look out before choosing the stock is the EPS or the earning per share. Now look at the last couple of years of EPS. If it's growing, then the company is doing good. If it's not, then it's worth looking at the reasons why. Is the company expanding, investing in more research, or is it incurring losses, which is a red flag? Second is the PE ratio. Now PE ratio or the price to earning ratio basically shows that if the trading price is overvalued or undervalued. The lower this value, the better. Third is market news. If the market news show a trend towards prospective growth, then it's worth looking at. So, how to invest in stocks? Now, I always suggest investors to invest 50% of their portfolio in growth stocks and 50% in value stocks. Now, growth stocks are investment in companies that are expected to grow revenues or earnings at a faster rate than the overall market. These are companies like Tesla, Nvidia, or Amazon. So basically companies that operate in high growth industries. They have a higher PE ratio and they don't pay dividends, rather invest their profits to keep growing. Now, value stocks are stocks of companies that appear undervalued compared to their intrinsic worth. These are mature, stable companies like Coca-Cola and Johnson & Johnson. They pay regular dividends and have low PE ratio. Now, the mix of growth and value stocks offers stability and a chance to earn dividends as well as growth prospect from a high growth environment. The third is bonds, in which I recommend to invest around 10%. Now, bonds provide stability and income, making them a good counterbalance to stocks. They are essentially a loan that you give to a government, corporation, or any entity, and in return, they pay you interest over a set period of time and then repay the full principal amount when the bond matures. So while stocks represent ownership in a company, bonds represent debt. And that makes them less risky, but also less lucrative over time. Now, bonds are far less volatile than stocks, helping you balance your portfolio during market downturns. When the stock market dips, bonds often hold their values or even rise. They also provide predictable income in the form of interest. Now, there are various kinds of bonds like government bonds, corporate bonds, municipal bonds, and high-yield bonds. Bonds are rated by agencies like Moody's and S&P. AAA rated bonds offer the highest safety, which is why I always recommend people to only invest in government or municipal bonds because they are generally AAA rated. The returns on government bonds is less because they are stable. If you want to maximize return while taking on some risk, you should consider the split of 40% government bonds, 50% municipal bonds, 20% corporate, and 10% high yield. So how to buy bonds? Through broker houses like Fidelity, Charles Schwab, and Vanguard. You can also directly invest in US Treasury bonds through the Treasury Direct website. Fourth is real estate, in which I again recommend to invest around 10%. Now, real estate is a gigantic investment type which spans from owning multifamily houses to short-term rentals to REITs. So covering entire real estate in a single video will require a full video by itself. But for the purposes of this video, let's talk about financial instruments that allow you to invest in real estate without physically owning one. Now, the first one is REITs. REITs, or real estate investment trusts, are companies that own, manage, or finance income-producing real estate. By law, REITs must pay out at least 90% of the taxable income to shareholders as dividends, making them a reliable source of passive income. Now, REITs provide steady income in the form of regular dividends that generate positive cash flow to its holders. REITs are freely tradable, so they can be bought and sold like shares. You can buy REITs for as little as the cost of one share on a stock exchange. At the time of making the video, these are the best performing REIT investments. Now, second is real estate crowdfunding. Crowdfunding platforms pool money from multiple investors to fund real estate projects like apartment complexes, commercial buildings, or residential developments. You invest alongside other investors and earn a share of returns. Just like REITs, you earn dividends or interest without direct property management. You also get access to invest in projects and property types not available through public markets, and you can get started with as little as $500. There are 3 reputable crowdfunding platforms that I suggest: Fundrise, Reality Mogul, and CrowdStreet. The last one is real estate mutual funds or real estate ETFs. Now, these are funds that invest in diversified portfolio of real estate assets, including REITs, property development companies, and real estate operating companies. They combine the benefit of REITs with the added diversification of mutual funds or ETFs. They spread your investment across multiple properties and companies, have minimal management fees, and are available through your brokerage accounts with no need for accreditation. Some of the good performing real estate mutual funds are these. So wrapping real estate up, if I was investing in online real estate, I would split my investments into 4% REITs, 4% crowdfunding, and 2% mutual funds and ETFs. Now, moving on to the last category of alternative investments, in which I suggest to again invest around 5 to 10%. Now, alternative investments are assets that fall outside of traditional categories like stocks, bonds, and cash. They include a wide range of options such as cryptocurrencies, commodities, paintings, vintage articles, and many more. But the 2 most important and accessible ones that we would like to discuss in this video are cryptocurrencies and commodities. Now, commodities more specifically includes investments in precious metals like gold and silver, either in physical form like bars or jewelry, or in the form of ETFs like these 2, which are traded on the stock exchange. Commodities are used to hedge against market volatility. They're generally stable in value and in recent years have seen appraisal thanks to the increased demand from investors. If you are in the US and have access to Costco, the wholesale store, I suggest buying gold bars from there as they come with a certificate of authenticity and have highly marketable value. Otherwise, make sure to get a certificate of authenticity from your dealer if you are buying the metal physically. Second is cryptocurrencies. Now, this is a highly volatile asset that currently seems to be rallying out of control. Now, cryptocurrencies are digital currencies that are outside of the regulatory purview and hence have no government backing. They are created for the sole purpose that you can control your own money and make transfer of money instant and easy. Now, I have been burned severely by investing in cryptocurrencies, so my advice for people looking to invest is to ensure that you do your research. Now, you can buy recognized assets like Bitcoin, ETH, Cardano, and XRP, but I would stay clear of meme coins as those seem to be quite shady. The best platforms to buy cryptocurrencies are Coinbase and Binance. You can also invest in Bitcoin ETF to minimize your risk. So that's it. Investing in your 30s and 40s may feel overwhelming, especially if you're starting with a limited budget. However, it's crucial to remember that every dollar invested today has the potential to grow substantially by the time you're ready for retirement. To those who feel they don't have enough money to invest, you actually don't need a large sum to get started. Even small monthly contributions add up over time, and the power of compounding can significantly boost your savings. So instead of focusing on how much you can invest, focus on building a habit. Automate monthly contributions, even if they are modest at first. Stay consistent, review your portfolio periodically, and keep learning. With patience and a steady approach, you'll be on your way to a secure and healthy retirement. Thank you so much for watching this video. If you like this video, you'll probably like this one here too, where I talk about the perils of home ownership at 40. Thanks again for your time, and I will see you in the next video.